I'm joined now by Alok Agarwal, Head of Quant and Fund Manager at Alchemy Capital Management. Alok, great to have you in the studio. Thank you so much for joining in. You know, just looking at how rocky the last few days has been and some kind of finality that one hopes for. Frankly, no one can say anything in these days. Do you think that the worst is behind us as far as the geopolitical play is concerned? And now we can start, worrying about domestic factors.
So rightly put, in fact, in the last 3 months or so, what has happened, starting this quarter with the tariff war kind of stuff, who would have imagined that would cool down so easily? Thereafter, the Pahalgam attack, Operation Sindoor, and this Middle East war as well seemed to have started and ended in less than 2 weeks' time. We can't really be too unhappy with the way markets have reacted to it. They have been pretty resilient, pretty strong. And all this is happening at a time when corporate earnings came off better, the macro indicators are improving. So we are in a much better spot than one would imagine, given the kind of backdrop of events that have happened.
Okay, and in this space right now, if you're looking at the markets right now, obviously come off the highs of the day, do you think that underlying concern is there that you will see a sell-on rise in the market even going further? I mean, we've seen quite a sharp drop from the highs of the day today.
Yeah, regarding 1 or 2 days, they may react to the news events. Markets in general, over the medium term to long term, they try to react more to the earnings side and the growth side, which numbers are improving. In fact, if you look at the current quarter's numbers also, when we went into the quarter, the estimates weren't really high. They were barely about touching double digits. But with Nifty 500 reporting close to 11-12% earnings growth, that's pretty good. And if we leave out the top 50 companies out of the Nifty 500, the bottom 450 actually reported more than 20% growth. So you can't really be complaining too much. And all this was for the March quarter. For the economic activity indicator in the month of April, the collections of GST in the month of May, which belongs to the activity in the month of April, that was highest since October 22. So numbers are looking up. Markets want to react more to that. Possibly that's one of the reasons for the resilience of the markets.
Were you worried about the advanced tax numbers and the file drop there?
Not too much out there, but yeah, I would have been happier to see a healthier growth.
Yeah.
But I would be more keen to see how the Q1 numbers pan out. The setting up looks pretty good, but yeah, looking for the Q1 numbers to be stronger.
Alok, joining in, wanting to understand, therefore, you've put into context very well in terms of your views, but put into context valuations, therefore. The large cap index not really looking particularly expensive, but not looking cheap either. The mid cap is actually more expensive than the 5-year averages. And the small cap is okay as well. So how do you rationalize that and where do you sit with regard to?
So Hersh, looking at the P ratios, it's easier to say that yes, mid caps and small caps are at a premium, but they need to be looked in context of the earnings growth as well. So let me first compare the P ratios itself. Today Nifty would be trading at somewhere around 22 times on a 1-year forward basis. And mid and small caps, especially mid caps, are trading somewhere around 35% premium to the Nifty.
Yes.
If you look at the last 5-year averages, there are also 35% premium. So we are in and around the averages of the last 5 years.
Sure.
The peak was 70% premium. So that peak has corrected. But you look at the earnings growth as well. If I just concentrate on Nifty 50 index or Nifty 100 index, Nifty 50 index next 2 years earnings growth are in the vicinity of just about 10%. But if you look at the mid-cap index or the broader market indices, the earnings growth estimates are close to high teens. So, for nearly double the kind of earnings growth projections for next 2 years, if you have to pay a 5-year average premium, will you call that too expensive? Is anybody's call.
Sure. And within that high PAT growth expectation, where do you find the opportunities? Where do they lie?
So the opportunities are lying in multiple sectors, and a lot of these sectors either are newer found sectors or they weren't doing well in the last decade. The ones which are newer found sectors, I would say the way the capital markets have bounced back, the way the travel industry in terms of be it aviation or the hotels, etc. have bounced back. The discretionary spend patterns have been changing. Say about 15 years ago, when India was under $2,000 per capita, what was discretionary is slowly becoming staple. And higher ticket discretionary items, especially after the COVID, which we saw as K-shaped recovery, that's becoming far more prevalent. So those segments are the ones that are bouncing back. electronic manufacturing was virtually absent. So
Yes.
that came to the forefront. Defense was virtually absent. So these have bounced back nicely and show good growth projections.
I'm just wondering how you're looking at IT right now, Alok, because there seems to be a divided house on it. The Accenture results put a bit of fear in the way people are looking at IT, but all things considered, if you're going to see a drop in interest rates in the United States coming in the July policy, and if recession fears recede, do you think Indian IT now has a fair shot as we set up for the next result season?
Short term, it's very difficult to call. Markets tend to have bounce backs or corrections in the short term. But when we look at slightly more medium term, it's difficult to be extremely positive on IT, at least the frontline IT as of now. The earnings growth, what has been there in the past compared to what can be in the future, they don't look as exciting. So see, it's no-brainer that given the kind of growth trajectory in the US or with the advent of AI, the kind of growth that the Indian IT saw in the last decade will be difficult to replicate in the next decade or next few years. And last 5 years and 10 years, their average as a sector, earnings growth has been just close to 10%.
Sure.
So a country which is growing at a nominal GDP of close to 11%, corporate earnings to GDP at a 17-year high, you need to have much higher growth rates to be considered to be overweight.
And then therefore, so give us some sectors and give us some themes that you're liking.
So the themes that we are liking, we do think that the manufacturing as a percentage of GDP has been rising, is likely to continue. It can be multiple segments out there, but the focus areas right now are more on the defense and power side. Possibly in coming years, it will be on the railway side as well. On the consumer discretionary side, we are more on the K-shaped recovery. So be it the high-end watches, be it the jewelry side, be it the high-end car side. Those are the segments that are doing well in the travel side, as well as I mentioned on the hotels and the aviation side. The electronic manufacturing is also an important part. Who would have imagined that electronic exports would become the largest export ticket item for India? The EMS space, and in discretionary, I would also classify financial services like capital markets within the discretionary space itself.
Sure.
So those are the areas that we are more positive on, and these segments are actually going at a much, much faster pace, and that's what we want to concentrate at.
Okay, and where is the confluence between growth and value? You've spoken about a few sectors. Some sectors have good growth, some sectors are looking good in terms of value. Where are you seeing that confluence?
That's a tough choice. To get in India a good growth and good quality and at a cheap price, that's very rare. Rare, it's extremely rare. If mining for gold is easier than finding those. But let me put it this way, instead of just focusing on the valuation or P ratio, focusing more on the PEG ratios would give you a much better idea.
Okay.
So given that the index is trading around 22x for a 10% growth, your market is available for 2.2x PEG ratios. If you can have much higher growth rates for a PEG ratio lesser than that, you are more or less in a territory which is called growth at a reasonable premium.
Point taken. Alok, what are you doing at this point? Are you sitting on cash? Are you going out and buying? Give us the strategy. How much of the fund has cash and how much of it is deployed? And talk to us about the last 3 months as well. What have you done in terms of deployment versus holding cash?
So as for me and as a house, we don't really believe into holding too much of cash.
Okay.
So we remain deployed. I'll share an interesting piece of data. A lot of such data have been shared. Last 20 years, we all say around 14-15% market returns have been there. But if you miss out just 2 days per year, which are the best days, sort of 5,000 days you are participating in, say 49-60 days, yet your returns could come down from 14-15% to about 5%. So it's a futile exercise in our view to really jump and say that what's going to happen and when the markets are going to rise and fall. Our expertise are more into finding which sectors and stocks are doing better and which are in a not so favorable position. So we believe into deploying the funds that we have. So we are majorly deploying, not taking cash calls.
Okay.
Focus areas are growth areas. So we are GARP investors. And for GARP, the first word is growth.
Yes.
And as I said, if the country's nominal GDP grows at around 11% and corporate earnings is rising at a faster pace, your portfolio corporate profit also needs to rise at a faster pace than that. So
Sure.
that's the area that we look at.
For viewers, the perspective, GARP is growth at the right price. And Alok, has been very kind in defining what the right price is a couple of times, including the peg ratio, which he said that the Nifty peg ratio is 2.2. Anything below that, with a decent kind of growth clip, visibility over the next 2 to 3 years could well be your pick. So thanks so much, Alok, for coming in.
Thank you.
Speaking
Pleasure.
with us.